Welcome to your Mortgage Insider Update. It is March the 16th. We are 16 days into the conflict in the Middle East, hoping for a little semblance of calm. The overall bond market's settling down a little bit to start this week off, as opposed to the last few weeks, where every Monday seems to have come with a weekend full of news. Most recent news sounds like there's going to be a coalition of countries, or at least there's been requests to make a coalition of countries to open up the Strait of Hormuz, with the global oil trade in that region coming to a halt. There has been a lot of talk of bringing other nations together. It's really the worldwide issue of 20% of the oil market coming through the Middle East. If that's halted, that's affecting the whole world. So everybody's starting to step in. We'll take a look and see how that plays out on the interest rate charts. It has been, like I said, a rough couple of weeks with no end in sight yet for the conflict. So beginning of the week, we have mortgage bond prices higher, bond yields lower, the 10-year Treasury being the easiest way to track kind of the direction of interest rates. And we can see it's been an uphill slide since the very last of February 27th. Severe drop off, lowest point in just below 4% on the 10-year Treasury, only to turn around on Monday and stair step up. There has been other points where things have calmed down. It was hopeful that rates could settle here in that 4.1, 4.2% range, but we missed that, breaking above the 200-day average last week and hitting highs. We can see the high point back here back in early February. So we did have a great month of February, slid interest rates significantly lower, only to see halfway through March here right back to where we started. So without the conflict in the Middle East, it is presumed that you'd have quite a bit lower interest rates. And if we can get some resolution, some calm in the Middle East, and maybe even a coalition to make sure the Straits of Hormuz is open and continues to flow goods and services throughout the world, we could see a settling back in interest rates back in that 4.1% or even lower range in the coming months. A quick glance at the 30-year mortgages, so mortgage-backed securities traded by investors that are buying the mortgages. Right now, they're having to pay a little higher price, whereas when they were not buying the mortgages the last few weeks, we saw the price drop. So an improvement in price means lower interest rates to the consumer. We can see a similar tale here. We have seen the bottom actually hitting the 200-day average on Friday, bouncing above that, not making significant headway to what we lost. What we lost was March 2nd. Interest rates falling significantly after hitting the top that had been established going back to the beginning of January. Not quite as volatile in the mortgage-backed security market, especially since the 1st of January was announced, or the second week in January, that the Trump administration is directing Fannie Mae and Freddie Mac to buy more mortgage-backed securities, expanding their avenues to keep liquid the mortgage market. And that kept us in a pretty steady range. But that's been unraveled over the number of weeks here that we've been involved in this conflict. So a little bit of a semblance of a bottom as far as the prices to mortgage-backed security, a high point in interest rates. So we could see a raising of prices and a decrease in consumer interest rates in the coming weeks as things start to calm down, assuming that they can calm down. So with that, we'll make it another great start to the week. It feels like spring out there. Go and enjoy the sun and try not to worry too much about what's going on in the nation and the world, but control what you can control. That's you. Have a great week.